Hello and welcome back, Almus, to Almus Market Mornings, folks, your daily dose of global financial updates. This is Shikhar Garg, your host, and we are heading towards quite an interesting day today. After the extreme low volatility in the past few weeks, we have the long awaited RBI MPC today, where the MPC, or our central bank, so as to say, is facing the challenge of buoying the Indian economy in this grim and gloom sort of an economy. Even the World Bank was seen cutting its forecast for the growth in GDP. And there was a very striking statement made by them wherein they were warning that several years of above average inflation and below average growth lies ahead. Quite a strong statement. So, JK, what do you think? How is the world going to fare, and what are we expecting out of MPC today?
Yeah, good morning. Thank you, Shika. Nothing much to write home about the equity markets yesterday because everyone is waiting for the slew of big events that lie ahead. So only thing of note was that initial sell-off in the equities was clawed back after the yields came below the highs. And in fact, 10-year once again traded below 3%. That was kind of support for the risk sentiment, but still nothing big actually, because people are waiting for the CPI inflation on Friday and the result of FOMC meeting next week. Of course, the Asian session was interesting because Australian Central Bank hiked the policy rate by 0.5% versus widely expected 0.25%. In fact, the statement accompanying said that they would take more steps in the process of normalizing monetary policy in Australia over the months ahead. It's certainly been a hawkish move, and the reaction of Audi has been, I would say, rather muted. But as we are still in a strong dollar environment. In the US session, we did have the US trade deficit announced, which narrowed the trade deficit by the most in 10 years. The deficit dropped by 19.1%, the largest decline since December 2012 to 87.1. And this record trade deficit in the last 2 months had actually shaved off about 3.2% of gross domestic product, resulting in GDP contracting at 1.5% annualized rate. But now with this improvement in the trade numbers, the growth rate might actually come out better in the final estimate. As Shikhar mentioned, we did have the global growth being downgraded by World Bank from 4.1% to 2.9%, warning that several years of above average inflation and below average growth lie ahead, with potentially destabilizing consequences for low and middle income economies. So even if global recession is averted, the pain of stagflation could persist for several years is what they are warning about. On the US dollar front, it was a mixed day for the dollar. Euro seeing another attempt to break support at 1.0650, but that was held. Despite surprise hike of 0.5% by Australian Central Bank, AUD made only a modest rally. UK pound, of course, was resilient, still getting help from the political news where Johnson won confidence vote. Of course, Dalian stole the show by rallying to a new 20-year high at 133, which once again aroused comments from Japanese officials. Japanese government said they were closely watching the currency market with a sense of urgency, and they also returned to a heightened state of alert following a renewed slide in the yen to fresh two-decade lows. We have heard these comments earlier too, and not sure whether they really mean to take any action in this regard. There seems to be no unanimity also among the various officials, as on the other side, Kuroda says that he will stick to the rock bottom interest rates for the time being, and also the ultra, easing measures. He also reiterated that weekend is good for Japan's economy if moves are cheap. My sense is that if dollar even starts to fall, yen will be the last to gain. Helping to bring the dollar down was also the fallback in US yields yesterday mildly, with the 10 ending the New York session at 2.98 versus 3.06% in Tokyo. Euro's weakness already depressed by the challenges of their third largest economy in the region, Italy, was further pushed lower to worse than expected industrial orders from Germany. Now, the all important event today for the Indian market is the Monetary Policy Committee's decision on rates. There's nothing much to write about in terms of intraday moves. Yesterday, it was in one of the lowest range of 4 paisa yesterday, and such a narrowing of trade band normally increases the chances of a burst of a big move sooner or later, but just awaits a trigger. We may well see RBI's rate decision serving as a trigger for it, as our central bank is likely to go in for a 0.5% hike. Such a move could see rupees stage a small rally, but that will be unsustainable. Needless to say that mere elevated yield attraction would not be sufficient to reverse rupees weakening trend, as the multi-year high inflation, impact on growth due to rising interest rates, unrelenting global crude prices, and the record high trade deficits will continue to have their negative influence on the economy, with many the global tightening conditions unlikely to bring in any big flows for now. So interest also surrounds around the forecast for inflation, which will in all likelihood be upped from the current 5.7 to above 6%. The forecast would probably give us a guide as to the terminal rate in this cycle of tightening, where the estimates are going up to 6%. Of course, World Bank had also downgraded India's growth rate for FY23 from 8.7 to 7.5%, citing many headwinds that the economy is facing, and FY24 also lowered to 7.1%. So it's a very interesting session ahead for us, because last time the MPC raised rates ahead of their scheduled meeting by 0.4%. Rupee weakened, above 77, and since then we have been trading above 77.5 for several days, and it will be interesting to see whether any attempt to break 77.80 will be once again stopped by RBI intervention, or whether the market looks to buy the rupee for a change with the added yield attraction. So that's what it is for the day. Wait for 10 a.m. announcement from Mr. Shaktikanta Das. Thank you.
Okay, definitely it is one of the long-awaited update from our central bank, and the address by Mr. Shaktikanta Das. On the small gist of what we've heard, we are still awaiting the CPI data, while the Aussie central bank hiked their rates, even though the currency move was a bit limited. On the domestic front, though, we are seeing, as JK mentioned, there is a possibility of a 50 basis hike, which can trigger a small rally, though. But the macros still are not really very favorable, because the trade deficit continues to be high. Even on the flows front, there's a long negative spell continuing. We are having straight 8 months of overall net negative flows for the Indian market. So guys, brace for some good movement in the coming days. There's a lot of events coming up. We hope you manage your rest till then. We get back again tomorrow morning. Thank you.